All right, welcome everyone to today's webinar. Today's moderator will be Ben Shepard, who's going to kick us off. So I'm going to turn it over to you, Ben.
Hello, everyone. Sorry for the late start, just a couple late ticks. Today is Wednesday, December 2nd, and we welcome you to our Business Disruption Series webinar entitled Insurance Claims and PPP Updates, a joint presentation between Nossaman LLP and Greenhouse & Jenks. Yes, my name is Ben Shepard. I'm a Managing Director in Greenhouse & Jenks Advisory Practice, and I will be moderating today's session. Joining me today, can we go to the next slide, please? Thank you. Oh, back one, please. Thank you. So joining me will be Jennifer Meeker, a partner and co-chair of Nossaman's Insurance Discovery Group. Next is Peter Brown, a partner and head of Greenhouse & Jenks Forensic Services Practice. We also have David Sutton, a managing director in Greenhouse & Jenks Transaction Advisory Services Practice and leader of the GHJ PPP response team. I'm looking forward to a lively discussion today about a number of hot topics. Let's go to the next slide, please. Thank you. First, Jennifer will help us understand the latest updates in property insurance issues. Next, Peter will discuss how companies impacted by COVID-19 can properly prepare a business interruption claim. Following that, David will give us an update on PPP loan issues, including loan forgiveness. Now, please feel free to forward your questions to the panel. As we have a lot to cover in a short amount of time, we may need to follow up with you separately after our discussion today. But before we jump in, let's have the first polling question. Has your organization suffered losses due to COVID? Please answer. All right, can we get a read back on what everyone's answers is? Oh, interesting. Very good. So this discussion is going to be right in line with most of you today. So let's get right to it and start with Jennifer, who will discuss the current state of property insurance claims. If we can go to slide 4, please. The next slide. Thank you. So Jennifer, thank you. Please give us a refresher on property insurance, the business interruption component of many property insurance policies, and how that BI coverage is typically triggered.
Of course. Thank you so much, Ben. And first of all, I want to thank you all for attending today's webinar and taking time out of your busy schedules. We, of course, always try to make sure that this is as informative as possible. And, you know, I want to apologize in advance. I do have a tendency of geeking out a little bit on the insurance stuff. So I'm going to try to keep this high level. But of course, if there are specific questions that come up, feel free to put them in the comments, or you guys can always contact me directly. But you know, the weeds of insurance recovery law are quite weedy. So I try to stay out of them on webinars like this. So, you know, the nice thing about this webinar is we are focusing on a specific type of insurance, and we will hit on some other insurance considerations a little bit later on a very high level. But this one, we get to kind of dive in a little bit more. So what we're seeing in the law right now is most folks are making claims for COVID related losses off of their first party insurance or commercial property insurance policies. Now, what property insurance is generally, and I'm assuming anybody who's on this call probably has it or is dealing with property insurance claims, so this is probably pretty basic, but it's an agreement by which your insurer agrees to indemnify the insured in the event that a designated property suffers a covered loss. So this isn't a situation where it'll just cover anything. You have to have the loss occur at the specific property that's covered by the policy. Now, a lot of policies will cover a lot of properties. You'll have riders onto your policies that are going to have, 10, 20, 30, 40, hundreds of properties. So the one thing is always making sure that the specific property that had a loss is the specific property that is making the claim, or is covered by the policy. Now, property insurance can be written on what's known as an open peril, or formerly an all risk policy, which covers everything unless it's expressly excluded, or on a named perils or specific perils basis, which covers physical loss from certain causes only, such as fire, windstorm, hail. Now, when you think of property insurance, you always think of the hurricanes and the wildfires and everything. So it may not be completely intuitive that property insurance may cover the loss of use of a specific property during the COVID times or during pandemics. And that's because most people don't think about what's known as the business interruption coverage. If we could go to the next slide, that'd be great. So now what business interruption covers is economic losses. So not, we got to rebuild the property because it was destroyed by a hurricane, but it covers the economic losses resulting from the inability to use the property for intended purposes. As part of this, assuming the policy has the right language, you'll also have the possibility of covering economic losses resulting from the inability to use covered property based on civil authority. So all of these COVID stay-at-home orders or shutdown orders that we've been dealing with, at least here in California, and frankly, I think all over the country, could trigger coverage under these policies. Now, what's the key to the question, and what all the fights have been over in the courts, are what is the definition of direct physical loss or damage, which is the common term used in these commercial property insurance policies and business interruption policy coverage. So if we can go to the next slide, that'd be great. So to get coverage, fundamentally, you need to have a direct physical loss or direct physical loss or damage to the property. So there's what's known in the insurance world, there's the ISO special forms, which most policies are written off of. And in that insuring agreement, it provides as follows: we will pay for direct physical loss of or damage to covered property at the premises described in the declarations caused by or resulting from any covered cause of loss. Now, in the special form, it also turns on when special is shown in the declarations, covered cause of loss means direct physical loss unless the loss is excluded or limited by this policy. So now what we've been seeing in the times of COVID is, what in the world does direct physical loss mean? And we have a pretty clear cut between what the insurers are arguing and what the policyholders are arguing. And so I want to run over those really quickly to kind of show you guys what the arguments are at the moment. And then we'll talk about a couple of cases, on what's winning and what's losing in the courts as of right now. So if I can go to the next slide. Maybe the next slide. Jumped ahead, sorry. So the insurer position, and I will say the insurers, if we're taking a tally here, the insurers are winning way more than the policyholders are winning, but that doesn't mean that hope is lost. So what's happening is the insurers are taking the position that you need to have that the actual presence or imminent threat of the presence of COVID-19 is not a covered direct physical loss or damage. And that's one piece of the argument, but the insurers are also arguing, putting aside whether COVID was even at the premises, the insurers are arguing that just the fact that a government order has closed down the use of a premises, such as a restaurant, in order to prevent COVID from spreading. They're also arguing that that is not a physical loss that is covered under these policies. Now, what is starting to shake out in the courts and wasn't clear until this pandemic, or wasn't completely clear before this pandemic, is what the insurers are doing are they're conflating the idea of a physical loss and a physical damage. So on the one hand, a damage is something normally pretty clear. If you've got a flood and all of a sudden all of the restaurant equipment is rotted out, that's clearly a damage. Now, there's less of a question of what's physical loss. So if you have, for example, there's mold because of a flood all over the premises, sure, that's a damage, but it can also be a loss. You can't have people eating at a restaurant that has mold growing all over the place. I mean, and that's a very basic, easy to understand level. Now, when we're talking about a virus, it's a little less clear on what is a physical loss versus what's a damage. And so what's happening is the insurers are arguing not only just that the existence of COVID on the actual premises is neither a direct physical loss or damage, but the risk of COVID and the shutdown orders to prevent the spread of COVID also is not a direct physical loss or damage. So really what they're doing is, despite the use of the word "or" as a disjunctive phrase, they're really just kind of meshing everything together in order to try to defeat coverage. So if we can move to the next slide, we'll talk about what the policyholders are arguing. Yes.
So Jennifer, let me just jump in. So even if there's something like civil authority coverage, how does that factor in?
So when there's civil authority coverage, there still needs to be a physical loss or damage. And so again, what they're arguing, and it has to be from a covered cause. So what they're arguing is that without even and again, you would think the presence of COVID in the building, somebody walks into your building and sits down at the restaurant and has COVID, and and aerosols are lands on the table. The insurers are saying that even that's not a covered cause. So what's happening with the civil authority is, even under most civil authority provisions in the policies, they're saying that you don't have that fundamental underlying issue that would be covered, and therefore you don't even get to tap into your civil authority policy.
Okay.
So now what the policyholders are arguing is, and again, taking a tally, we're not doing, and I represent only policyholders, and we're not doing so great, but there are some wins out there, so that's a good thing. But the strongest policyholder argument has focused on the meaning of direct physical loss, which is not normally defined in a property policy. Now, courts have been starting to recognize that loss and damage are not synonyms, and each term has to be afforded its own meaning. So just because you may not have damage per se, you may still have a loss, and that's what certain courts are starting to come around to. Now, what we've been arguing is a reasonable interpretation of direct physical loss is the loss of the ability to safely use the property for intended purposes. Now, this would mean, even without a civil authority order, if we've got a situation where, we've got a spike in cases and we can't open our restaurants with a stay-at-home order or not, and do so safely, then we would argue that that's a direct physical loss caused by the virus. The same would be even more clear when you have a civil authority which says, no, you really can't open or stay open and have people in your restaurant or your premises. So, that's what we've been arguing, and we have been starting to get some judges who have taken the bite on this. Now, this is where I geek out a bit and have some fun with the policies is, and frankly, what's keeping me kind of employed is you know, where does this all come from? And what we're all arguing is that this all is arising from insurance contract interpretation principles. So for example, in California, when you're interpreting a insurance contract, there are certain rules that we play by. So if a term is not defined, then that gives us a little bit more leeway to argue different meanings. Now, if a term is ambiguous, which means under the law that there are more than one reasonable interpretation of a phrase or a term, then any ambiguity actually needs to be interpreted against the insurance company. So for us as policyholders, you know, we're taking the terms and the words put in that policy, and we're, you know, we're interpreting them to make sure that the reasonable expectations of the policyholder are being protected. Now, would a reasonable policyholder have bought an insurance policy that wouldn't have covered, you know, a shutdown from a pandemic? You know, maybe, maybe not. I mean, most of us, this wasn't even something we were talking about. But the key is that while a insurance contract is still a contract and the parties can agree on what they put in there, there still has to be some expectation by the policyholder against the insurance company that they're going to get value for what they've paid for, and it's not going to be just limited to, say, a wildfire or, say, a hurricane or whatnot. So, you know, that's where the fights have been, is on what does the policy mean when a lot of these terms just aren't applied and defined and haven't been applied in the past because we haven't really gone through such a pandemic like this in the past. So I'd like to talk about a couple of cases. And so if we could probably skip the next slide and just move straight to the following, there we go. Okay, so as I mentioned a few minutes ago, most of the cases are coming out in favor of the insurance companies. That said, there are hundreds of cases throughout the entire United States right now that have not been decided at all. There's some that are being resolved, some that have come out in favor of the insurance companies and the policyholders, and then we are in varying degrees of hundreds of other cases. I actually did a summary of everything, and I've got over 100 pages of cases that are either pending or have been decided in a multiple different you know, ways. So, you know, I'm going to talk really quickly about the insurance companies, and then I want to move to the policyholders because I think that's probably more interesting to everybody here. But what there has been happening, we don't have anything in the circuit courts. And giving a brief background on the court systems, you have the state court systems, and then you have the federal court systems. A lot of insurance cases end up in federal court because you have what's known as diversity of jurisdiction. You have an insurance company who's, say, headquartered out of Delaware, and then you have a mom and pop restaurant here in California. So there's two different states involved. So a lot of them end up in federal court. We will end up looking at a lot of cases out of the circuit courts, but the federal circuit courts are going to look to state law. And so a federal court sitting in California is going to look to California state law about insurance policy interpretation. So one case that has come out that's been used as a reason to deny coverage has been this Mama Joe's case, which is in the 11th Circuit, which is covers areas such as Florida. Now, it's not actually a COVID case, but what it was talking about was the cases coming in, or dirt coming in from a road construction project, and whether that was a physical loss or damage, and the court said no. So courts have been around the country saying, well, if that's, you know, dirt isn't a physical damage or loss, then we certainly don't have a physical damage or loss with this virus. Now, they're making the same arguments that we've been seeing. They're conflating damage and loss together, and so, you know, the courts are in fact buying it. So let's talk about what's more interesting, which is what our courts have been doing for the policyholders. And if we can go to the next slide. So as mentioned, we have been having, most of our cases are very early on, and most of the cases have been being resolved on what's known as a motion to dismiss. That's based just purely on the pleadings. Now the North State Deli case, which is out of North Carolina, is the first really big win for the policyholders, and it happened on October 9th of 2020. And a state court in North Carolina ruled in favor of the policyholder on summary judgment, which means the policyholder wins coverage, period. Doesn't have to go to trial, doesn't have to do anything else, they have won. And the court held that the term direct physical loss covers business income losses caused by the COVID shutdowns. And so this was, truly so far the first and frankly the only really big win for policyholders. Now, the North Star case involved 16 different restaurants throughout North Carolina, and they filed suit against Cincinnati Insurance Company. Now, Cincinnati had denied their claims, of course, claiming that there was no physical loss caused by the shutdown orders in North Carolina. Now, what the policyholder argued and what ended up winning was this contract interpretation situation. The policyholder argued that there was direct physical loss because they've lost the use of their premises because of these virus shutdown orders. Now the court said, okay, well, that's a reasonable interpretation of the policy and the word loss, and loss does mean something different than damage. And so we have to give meaning to the word loss, and we can't just say that it's damage. So since this is a reasonable interpretation, even if there are other reasonable interpretations that would mean that there's no coverage, because under the law, a ambiguity has to be interpreted against the insurance company, the court said that the policyholder won coverage, and so the Cincinnati Insurance Company was required to cover all of North State Deli's losses. So that was a big win. If we can go to the next slide. Now there's been a couple of others. Again, it's slim pickings a little bit here, but I did want to highlight two others, one out of Pennsylvania and one out of Missouri. So in the Pennsylvania case, which is Taps and Bourbon on Terrace versus Lloyd's, in that case, it was another similar claim about a restaurant. Now, the insurance company in that case argued that not only did Taps and Bourbon not suffer a direct physical loss, but there was also a virus exclusion. And we'll talk about that a little bit more a little bit later on, but focusing on direct physical loss. In response, the policyholder argued that, same as in the previous case, the fact that they could not use the premises constituted a direct physical loss of the use of the premises. They also argued against the language of the virus exclusion, and it gets a little bit nuanced, but the argument high level was that Lloyd's was arguing that the policy couldn't cover any of this period and stop because there was no direct loss under the plain terms of the policy. So it didn't even matter about the virus exclusion. Now, what the policyholder argued in response was, well, if there's no possible way that a virus or a civil authority shutdown could ever be covered under this policy, then why do we even have a virus exclusion? And so, there was all these arguments back against the insurance company, rebutting these, their claims. And the court finally said in a motion to dismiss, so not a summary judgment motion, but in a motion to dismiss, you know what, there's enough here, we're going to let it go forward. So the case is not over. They either are going to need to eventually file a summary judgment motion after a discovery, or they'll need to go to trial on whether there's coverage. But that was a case that was able to push through as opposed to being dismissed early on in the process. Now, Studio 417 is actually a case that has been used by policyholders a lot lately in terms of making arguments for coverage. And it's, again, a very similar fact scenario, although this involved hair salons, that their government shut down, they couldn't use their premises. But in that case, the policyholder also made an argument that it's likely that certain customers were coming into the premises with COVID. And with it, with the COVID situation of being asymptomatic and everything, nobody could really just know, whether it was, just a risk of COVID or whether in fact COVID had appeared. So they argued, actual presence of COVID. They argued that that risk made the use of the premises unsafe. And then they also argued the emergency orders. And that's another case where the court allowed it to survive the motion dismiss stage and move into discovery and further proceedings. So those have been, a few cases on our favor. They're very fact specific. They're also very specific about what language is used, whether there's a virus exclusion, what the policy says. And so it's hard to say straight on, based on these three cases, for example, as a policyholder, we're going to win. Ultimately, when you're making that determination, you really have to dig into your facts, your shutdown orders, your policy, and the entire package of what's going on before anybody can evaluate whether there's a good chance or not so good chance of winning a coverage case. So I know I don't want to take up, I feel like I'm talking a lot here, so I'm going to move through a couple things really quickly. So the next, if we can move the next slide. So there are some courts that have been having some mixed results. So they're finding, under certain arguments, there's no coverage, and under other arguments, there could be coverage. And even if you have a mixed result like that, you're going to be able to slide through and get into discovery. So you don't have to win everything in order to be able to get coverage for some of the things. And so this Texas case is an example, and if anybody has any questions about it, I can certainly fill everybody in on that later.
So Jennifer, no, just to jump in. So what have you heard about the efforts to consolidate some of these cases, either by geography or by insurance carriers, such as in like a multi-district litigation?
Yes, absolutely. And I'm sure that's on a lot of people's minds, because it would really help get some quick clarity on these issues. So far, there have been a number of efforts to consolidate. And if we can move to the next slide. So there have been a number of efforts to consolidate, and so far none of them have taken hold. So one of the more recent ones was in the, and it was a very broad motion to consolidate. And it's in Ray COVID-19 business interruption protection insurance litigations. And in this case, the MDL actually said no. We're not gonna do this. This is just, that's too big. And it would have actually covered basically every business interruption claim under almost every policy out there in almost every state. And that was just too much. So the court said no, but it did leave open the possibility of insurer specific MDLs, which what that would do is say all the Lloyd's claims, regardless of in what state, would all be consolidated into one action. So if we can move to the next slide. So now there are a couple of pending MDL requests, and you guys can see that they're starting to get a little bit more narrowed down instead of every single claim against every other insurer in the entire country. So in Ray National Ski Pass Insurance, which is out of Arkansas, there's been a motion to consolidate all cases for specifically canceled ski trips. In Ray National Travel Insurance Litigation, which is out of Texas, there's been an effort to consolidate all COVID-related travel insurance coverage cases. And that was a specific policy. If we could move to the next slide. So we have, this is out of the MDL, which is a federal situation, but we do have one case where it's a coordination of litigation within a state. And on July 23rd, 2020, in Pennsylvania, the court consolidated every case against Erie Insurance, so a specific insurer, to be handled from that point forward in this consolidated case. So, you know, a more limited consolidation is starting to pop up, but the broad, everybody gets dealt with at the same time type of litigation has been so far rejected. So,
I'm muted. So no, let me jump in, Jennifer. So based upon all this information that you've gained, would you still advise your clients to go ahead and file a BI claim, even if the COVID coverage may be initially denied?
Absolutely. And if we can go to the next slide. So, you know, there's a lot of things, as I mentioned earlier, all of this is going to depend on your specific facts and your specific language. So there's that piece, but the other piece is all of this is super new. We lawyers are dealing with these, what's coming out on a daily basis. In April of this year, we had basically no guidance here. I mean, we were using cases dealing with Ebola and SARS outbreaks, but they were very, very limited. So this is all new law. And what's happening is because it's new law, you don't have any binding law. There hasn't yet been any what's known as a published decision where it has gone one way or another. And even if there's a published decision in, say, Arkansas, that's not going to necessarily have, you know, it's actually not necessarily, it has no binding authority or effect on something that's happening in California. So what we're looking at is all these arguments, and trial courts are making decisions, but they're not binding on anything. And until we get a published decision by a court of appeal in the jurisdiction that you're in, there's, you know, you're kind of a free-for-all to be able to make whatever arguments you want to make. So for those reasons, you know, besides your facts and making sure that everything kind of, you have the arguments that you can make in good faith, combined with the fact that there's just no published binding law out there yet, I recommend all my clients, unless I can't make the argument in good faith, I recommend that all of my clients still make a claim, and still, you know, if they've got a good enough argument, you know, we file suit and we go forward, because it could be that right now, you know, yeah, the kind of odds are stacked against policyholders, but it could be all of a sudden 6 months from now, we have a wave of published decisions that are saying, whoa, trial court, when you deny coverage in these 20 cases, you were wrong. You should have found that there was coverage. So at that point, now you've got binding law that says that there is coverage, in which case, if you don't make your claim, you're going to be kind of out of luck for not sending in a timely claim. So that's my recommendation is, you know, always make your claim, even if there's a doubt, when you have such uncertainty as we do right now.
So Jennifer, I'm not sure if there's another slide that you wanted to cover, but before we turn to the next part of the presentation, I know we've talked a lot about property damage insurance, the first party type coverage, but in terms of third party coverage, what types of insurance coverage should our clients and your clients be thinking about directly related to COVID?
Sure. So, and this is, you know, off of everybody's minds, although we're starting to see lawsuits coming up under CGL policies. We're starting to see some policy or lawsuits pop up under cyber policies, and some of the D&O policies and some EPL policies. And let me kind of just throw out there really quickly, because I want to make sure that everybody else has a chance to talk. I don't want to dominate too much. But an example of a CGL policy. So your commercial general liability covers bodily injury and property damage to third parties, so not to you. And what they're seeing are things like a contractor will come onto somebody's property to perform some kind of service, and they catch COVID. That would be arguably covered under a commercial general liability policy. Under a D&O policy, if you have a business, for example, and you decided not to follow the rules, or you did not take sufficient steps to protect the premises from COVID and the people using the premises from COVID, there have been claims out there that you violated a D&O's directors and officers, that as a decision maker, you were negligent. You should have, taken better steps. So there's been some of those policy claims popping up. Now, cyber is an interesting one, and we're seeing it's not super on everybody's radar yet, but there's been a couple of lawsuits on cyber with everybody being sent home, especially in the professional world, to work, and we're all working from our own computers and our own phone lines and everything, and we're less protected than we otherwise might have been under the network in our offices. There's getting to be some questions about cyber issues and claims arising out of cyber risks from having employees working from home. So those are other areas that people are seeing losses, and there a lot of your policy packages, while maybe not covered by first party property coverage, may be covered by other policies. And so for us lawyers, when we have our clients asking us to do a policy review to see if there's coverage, we're asking for all the policies, because I don't have to just make a claim under one policy. I can make a claim under every policy you have that might be implicated. So those are other things to definitely keep in the back of your mind as this new reality that we're living in goes on.
Thanks, Jennifer. You've given us a lot to think about and a lot to look forward to. So can we have the next polling question, please? Is your organization planning to file a COVID business interruption claim? So please answer. We'll give a few seconds and then we'll recap. Okay, let's see the results, please. So most of you are not sure yet. So this discussion is going to be very timely. All right, great. Let's turn to Peter, who will be discussing business interruption claims in the time of COVID. Hi, Peter.
Hey, everybody. Thanks for having me here. And thanks, Jenny. That was a great presentation. And taking your advice to file a claim, let's go ahead and prepare a claim, right? So what do you want to do? Go to the next slide, please. Well, you need a plan and you need a team, right? And so we recommend that you form a special committee within your company, or just a team of folks that will include both internal and external resources. From an internal perspective, you need a captain of the team, right? And if you're lucky enough or big enough to have in-house legal counsel, we would recommend that person or group take charge of actually, dealing with the broker, dealing with your adjusters, et cetera. Have them be the captain, but you're also going to need, at the end of the day, right, this all comes down to money. And so you need some folks from accounting to be part of that team. There's a big people component here, payroll, expenses, et cetera. You're going to want to have HR involved with that. And then also operations. Operations is going to be able to tell you what was affected by the COVID related losses. And the other folks that we like to see on a team are actually facilities people. So the people that actually know about the condition of the facilities are great to have on your team as well. You're going to want to supplement that with some external resources. And you might think that the first folks I would say to hire would be CPAs. No, first person you want to hire is a lawyer. So you want to get someone on your team like Jenny who knows coverage issues and can represent you with the carrier. So definitely get your lawyer involved first, external legal counsel, and then if needed, they can bring in folks such as us, forensic accountants, to help prepare the claim. So what information do you need, right? Well, you need accounting records, obviously, right? So when we're talking about accounting records, make sure you're starting to gather those. Those would be things such as your profit and loss statements, payroll records, invoices and evidence of you actually paying expenses. So gather all those up. And then the other thing you want to do is supplement that actually with photographs. We recommend that you take lots of photos of your business. We actually have some clients that hit the COVID lotto. They actually got shut down by civil authority, and then they got looted and had vandalism to their property. Well, those folks are definitely going to want to have photos to document the losses that they've incurred. The next thing is make sure you're doing your own calculations. The insurance company is more than happy to do their own calculation of what they believe your loss is going to be, right? When we were preparing for this panel discussion, Jenny gave you an example recently where she had a client where she had, the carrier came back with their number. She hired an advisor that gave her a number that was $4 million more than what the carrier came back with. And they fully supported their claim. And guess what? They got $4 million for their client, more than what the carrier was asking. So definitely prepare your own calculations. You can do that in-house working with your attorney. But if they start to get a little bit more complicated, we would recommend that you get a CPA, a forensic firm such as ourselves involved. The other thing you want to do is you want to demonstrate good faith. And good faith means mitigating your losses or minimizing your losses. And how do you do that? Well, you do that by cutting corners where you can, but sometimes it actually means incurring additional expense, such as, let's assume that you had a big order, you wanted to fill that order, but your supplier no longer was able to perform because of COVID. You could simply just cancel that contract. But the other thing you could do is potentially go out and find an additional or a supplementary supplier. Even if that supplier costs more money, you're demonstrating to the carrier that you're actually acting in good faith and trying to preserve those contracts. So that's another big piece of it. Can you go to the next slide, please?
So Peter, how should the business interruption claim actually factor in the period of the primary loss, plus how long it takes for the business to recover?
That's a beautiful question. Thanks, Ben. So we have this little handy dandy chart here to help us. So really there's 3 periods of time that we want to look at, right? The first period is the pre-loss period, the pre-COVID period, the January 2020 period. So let's assume we have a business, our business is just cruising along, we're actually have a little bit of growth. And so that's really the green line or the green and yellow line in the pre-loss period together. That's what happened, pre-loss. And then you would expect that, projection to go forward, your business to continue to cruise along. And that would have happened, and we say, but for COVID, we would have just stayed on that steady green line. But what happened? We got shut down, right? So the government shut us down, we went down to 0. So essentially what our loss is going to be is the difference between what we would have had but for the loss and our actual experience. In this case, we got shut down. Now, what's going to happen at some point, and this had an example, let's assume we were able to open back up in, let's say, July of 2020. We opened the doors again. Now, this is where you want to get some advice from Jenny on what your policy actually covers. The loss period and this period of recovery are typically referred to as the period of indemnity. And so your policy may only cover you until you open the doors again. So example would be a fire. I had a fire in my business. I got it cleaned up, I got it repainted, and then we opened the doors again. Now, you may not have gotten all your sales or all your customers back, but you're open for business. That might be the end point of where your policy stops. But if you have this extended period, which is referred to as an extended period of indemnity, you can actually continue to get coverage all the way up to the point where you rebuild your business back. So if we're looking at that recovery period, until that yellow line meets the green line, you could potentially still have a loss that's covered by your policy. And Jenny, if you want to jump in on any of this, just go for it. But so with that, so that's the time period. So now let's just go to see how you actually nuts and bolts put the claim together. Go to the next slide, please. Okay, so really, I mean, the good news about business interruption coverage, it just makes a lot of common sense. So let's assume we have a business owner, and we'll call her Calamity Jane. And let's assume that she had a restaurant, and she was making $50,000 a month in sales. And she actually, at the end of the day, before she put money, you know, as putting money in her pocket before income taxes, she put $5,000 a month in her pocket, right? What your coverage, the first component of your coverage is going to be not your lost sales, it's going to be your lost income. So it's going to be that $5,000 a month that you lost as a result of having to shut down. That's the first piece. The second piece that's going to be typically covered is continuing expenses. So Calamity Jane did the good thing. She decided to keep everybody on her payroll during this COVID crisis. Number one, because she's a good person and she didn't want to actually have to go out and hire all new people when this thing ends. You know, number two, she wants to take care of her employees, and I would argue that's good from a public policy perspective. And number three, the good news is the carrier will actually typically pay for these things, the continuing expenses. So if you pay things such as payroll and rent and other things during the period of loss, your policy typically will cover those things. So you get to add your lost income and then what you're out of pocket with respect to your continuing expenses. And then there's a third component that actually is extra expense. So let's think about things such as, you know, in my town, I live in the South Bay of Los Angeles, and there's actually restaurants around here that are completely boarded up and fenced off. They've shut down completely. The additional cost to actually board up those restaurants, to fence those restaurants, to actually, you know, pay for additional security, those are extra expenses that typically would be part of what you'd be able to claim as well. So you take all those three components, you add them together, and essentially you put that business owner back in the same place they were before COVID hit. And that is your claim.
Okay. So Peter, a couple of questions before we move on to the next section. What are, you know, in your experience, are some common mistakes that policyholders make when preparing the BI claims?
Yep, great, thank you. So, and I actually didn't come up with these myself. I actually did some research, and this actually comes from the carriers themselves. So if we look at these three buckets, the first one is lost business income. What people do sometimes is they actually claim lost sales. It's not lost sales, it's lost income. So you're greatly overstating your claim if you're claiming lost sales. The next thing is you want to make sure that you have your story straight with respect to what your expenses are. So for instance, on your lost business income, you're going to have payroll as a typical expense. Well, that payroll has to make sense if you're also claiming it as a continuing expense. And what we see a lot of times is that folks will essentially include a larger amount for payroll in their continuing expense than they do in their lost business income. We call that fudging the numbers, and that is a technical accounting term. You don't want to do that. You want to make sure that you have consistency between your continuing expenses or your lost business income piece, or at least have a story that makes sense as to why those are different, right? The other thing is sometimes there is double counting between extra expenses and continuing expenses. So let's go back to Calamity Jane, and let's assume that she has one of her bartenders actually service security of her restaurant while it's closed. That's a great thing to do, but you can't claim the bartender's payroll on your continuing expense and then also claim it as an additional expense as saying it's additional security. That would be double counting those costs, and a lot of times that happens as well. So those are just some of the major pieces or mistakes that people make.
And so, Peter, just to follow up, as we sit here knowing everything that we know right now, what should policyholders be doing if they're planning or considering making a BI claim?
Yeah, again, I think you got to go back to the beginning and have a plan and have a team and then gather information. That's the biggest thing right now. You know, you always want to get your data in order first, gather your information, and then start getting that advice. Get that advice from your broker, see what they say, and then also we suggest go ahead and get some legal advice and then go from there.
Thanks, Peter. That's really helpful and very valuable guidance, especially right now. So let's, before we move on to the next section, let's have our last two polling questions. First one, did your organization receive a PPP loan? Please answer. All right, let's see the results, please. Oh, most of you did. Excellent. And let's shoot over to the next poll question, please. If your organization did receive a PPP loan, have you already filed for forgiveness? Please answer. And can we see the results, please? Not yet. Again, a very timely discussion coming up. So let's now turn to David. Hey, David. He has some updates on PPP loans and upcoming loan forgiveness issues. So,
yep.
So David,
Ben.
So given the evolving guidance from the SBA, what is the current state of how companies should be documenting their compliance with obtaining the PPP loan, especially for those loans greater than $2 million?
Yeah, it's a good question. And, you know, I think the documentation element of PPP has been fairly consistent. So in terms of demonstrating the need for the funding, in terms of receiving the funding and actually using the PPP proceeds during the covered period, the advice has been fairly consistent around that, which is where possible, have a separate bank account, where possible, have a separate GL account, and transact the individual, or I should say record the individual journal entries that match up to the cash movements, really to show that traceability from funds coming in to where they were used, and really making the exercise of tracing where funds were spent for forgiveness purposes really just as straightforward as possible. And in terms of eligibility for the PPP loan, and you referenced, Ben, particularly for folks who borrowed more than $2 million, the commentary that was put out at the start of the PPP program was really around putting together a memorandum, a forecast, looking at prior years, factoring all the considerations of the individual specific business, vendors, customers, supply chains, shutdowns, really to get to the crux of sufficient uncertainty, which were the two big words that were used in terms of being eligible for a PPP loan. And we'll come back to that in terms of what's on the horizon for PPP as well.
Well, same question. Let's talk about documenting compliance with PPP loan forgiveness. What have you heard there?
Yeah, it's an interesting one, actually. So the forgiveness application forms, and there's a couple of different forms, but by and large, the documentation requirements are somewhat similar, actually spell out documents that need to be filed with the application, as well as documents that need to be collated and retained, but not necessarily filed at the time the forgiveness application is filed. So they do need to be retained for later inspection if the SBA so requires. So that those things are fairly spelled out. There are a couple of nuances to consider, which actually I was going to address later, but since we're on the subject, I'll talk about it now. One of those documentation requirements is the 941, or the payroll tax returns. And what we're seeing there is those returns are quarterly. And so if the forgiveness window that's being filed bleeds over a quarter end, does the borrower have to wait until the end of that quarter in order to have the 941 completed and filed to go then along with the application form for forgiveness? That's a question mark. I've seen some lenders say that they're flexible on that, and it is a lender decision, not an SBA decision. I've seen others that have said, you know what, we are going to wait for the 941 to be filed at the end of the quarter, and then thereafter we'll file our forgiveness. So the documentation for forgiveness is fairly spelled out in the application form itself, but there are some nuances such as the 941 to look out for as well.
Okay. What would you advise companies as when to submit the loan forgiveness application?
Yeah, that's a good question. And I would say for that, we're really in a period now where the tables have turned somewhat. So, you know, early October, maybe late October, a lot of lenders started to open up their portals where borrowers would go in and submit their documentation to apply for forgiveness and so forth. Up until that point, I think the general market commentary was, okay, we can go ahead and prepare the application form and maybe get ready to submit, but not to submit as yet. Not only because the portals were not open, but there were also a lot of question marks around what is the covered period? Can we go somewhere in between the 8 weeks and the 24 weeks? Is there a new stimulus package potentially coming that might change how we look at forgiveness? I would say that was the story and the sort of the general commentary up until late October, early November, versus now lenders, most lenders that I've seen have opened their application portals. The discussions about stimulus package have, you know, they reached a peak and then they came back down, particularly around the election time. And now there's just not really anything on the horizon as far as future stimulus, at least with any certainty. And so now I think the general commentary is, barring a reason not to, go ahead and get your application form completed and submitted. Go ahead and submit that form. The other thing to think about there is, with those portals opening up, there's going to be quite a queue, and having your form submitted potentially will mean a much quicker process to have the forgiveness reviewed and completed by the lender versus, you know, if you were to wait a month, it might ultimately delay the forgiveness review by more than 1 month. So an exponential impact there. So for timing, I think we're at the point now where we'd say, if you are reaching full forgiveness, which a lot of borrowers that I've worked with now are, based on the 24-week extension, is to go ahead and submit that forgiveness application rather than wait.
Thank you, David. And I wish we could talk more, but it looks like we're out of our time here. I wanted to thank all of you for your interest and your attention. Now, we received a number of questions today. We will make sure to follow up with you following the program. Of course, if you have any questions or potential issue in the future, please feel free to reach out. Our respective contact information is contained on our bio slides at the end of the slide deck, which I understand will be sent out to all of you. Again, I wanted to thank our panelists one more time for their guidance, Jennifer Meeker of Nossaman, and Peter Brown and David Sutton of Greenhouse and Jenks. Please continue to stay safe and have a great day. Goodbye for now.